Okay guys, welcome to today's class. We're gonna be starting with introduction to forex trading. Okay, so you might be hearing about forex. You might have actually come across where an advertisement about the forex market, how to trade the forex market, and there are a lot of them. So but this class this evening, we are going to be looking to the introduction of what this forex market is all about. Okay, so quickly let's dive into the class. Firstly, we're going to be discussing what is forex trading. Forex trading, also known as foreign exchange trading, is the process of buying and selling currencies with the aim of making a profit. It is like exchanging money when traveling abroad, but instead of using cash, you are trading currency electronically. Now, I believe this is much more clear to layman term understanding. Okay, so this is the process of forex trading is like doing interchanging of exchanging of what currencies to another. Okay, but here in the forex market, you are doing it electronically because you are trading it using what an electronic what system. Okay, examples meaning euro US, that means um the euro pounds slash USD, buying euro with US dollars, hoping to sell them at a higher price later. Okay, so for those that are in Nigeria, for those that are in other countries, we have what we call the Bureau de change and the rest of them. You can actually take your local currency to the Bureau de change and exchange them to the US dollar or to any other country currency, hoping that there may be a news that will trigger you to sell that particular currency at a higher rate, making an extra what income on your own what currency. Okay, so it just applies to that. I can use the Nigerian currency, that is naira, to you can also go and exchange your naira to USD. Okay, doing the brain change. But here in the forex market, you trade it every day with the economic what news. Okay, whereby you buy USD against euro or euro against USD, or sell euro against USD or USD against euro. Okay, so that applies to USD JPY, selling USD JPY for Japanese yen, anticipating a rise in the yen's what value. So if you are selling the USD dollar for Japanese yen, okay, let me say you have a US dollar with you and you go to the Bureau de change and you said exchange this US dollar to Japanese yen for me. Okay, that means we are anticipating that probably the Japanese yen will rise against US dollar, which means if you bought USD dollar of if you have USD dollar of $100 and you exchange it to Japanese yen, we are anticipating that when the when the Japanese yen what increases in value, you'll be making approximately about $120-$140 at the interest rates. Okay, that's the anticipation of what a rise in the Japanese what yen. Okay, that's what it tells on what selling USD against the Japanese yen. Now you can say, okay, buying GBP, that's Great Britain pounds against USD, buying Britain pounds with USD dollar, expecting the pounds to what strengthen. Okay, so the same process, you went to the Bureau de change and or where they exchange money and exchange your USD to British pounds, expecting the British pounds to do what? Rise. And when it rise, you sell it back to USD, okay, and make your profit. But in the forex market, which is the electronical way of doing it, we are trading it electronically using what? Apps. Okay, so you do it on day-to-day activity. So there is economic news that affects those things what daily. Other examples was a US company to import goods from Japan and needs to buy yen to pay for them. A trader buys Australian dollars with USD, hoping to profit from the difference in the interest rate, a tourist exchange that a tourist exchange their currency for the local currency while what traveling. Okay, from anywhere you're watching this video from, you when moving to another country, when you get to their border, you exchange your country currency to the country currency you are entering. That is called what? Forex trading. Okay, that's what forex trading is all about. But while it's different in ours that we do it what electronically. Importance of forex trading. One, global market. Forex is the largest and the most liquid financial market in the world with over 6 trillion traded what daily. So people changes money day to day, day in and day out. Okay. Economic indicator. Forex trading reflects the economic health of what countries and helps determine exchange rate. Do you get it? So forex trading helps what economic health of what a particular country. You can see some country their currencies are declining. Okay, so it affects also the forex what market. Investment opportunities. Forex trading offers opportunities for investors to profit from currency what fluctuations. Okay, so if I should buy the USD dollar with my naira or with Ghanaian cedis, and Ghanaian cedis is depreciating or naira is depreciating against US dollar, which means me that is holding the USD dollar is in profit. Okay, so it gives an opportunity to investors to make what a lot of money in the market. Okay, we're going to be looking at differences between forex and other financial stock, other financial market like stocks. Okay, ownership. Stock represent ownership in companies, while forex trading involves buying and what selling of currencies. So you can see people buying shares and all of that. That has to do with stock and the rest of them in companies. Okay, those ones has ownership, but in forex trading you don't have ownership. It only involves what buying and selling of currencies. Market market hours. Stock has fixed hours, whereas forex market operates what 24 what 5, not 24/7. So which means it's 24 hours every day, but 5 times in a week. Okay. Difference between forex and other financial institutions like commodities. Again, physical goods. Commodities are what? Physical goods like gold, oil or wheat, whereas forex trading involves intangible what? Currencies. Market dynamics. Commodity prices are influenced by supply and demand, whereas forex prices are driven by economic what indicators and what interest rate. Do you get it? So if there is a shortage for those that are trading commodities, because you still trade commodities in forex, okay? So but if you're trading commodities like gold and all those things, they are being affected. Let's say you are supplying oil to a particular seller and you are supplying about 5 gallons, but when the season for oil is trying to go down, you now go down to shortage of about 3 gallons supply. That means you are losing, not even increasing. So that alone affects the transaction of the business you have with the supplier you're supplying to. So that's how the commodities works. Okay, while the forex market is driven by what the economic indicator of interest rate. So you can wake up to hear news that, like, you can see what is happening recently within Trump and the rest, tariff and the rest of them. That's what affects the what the uh, um that's what affects what the forex what market. Simple analogies: currency exchange. Imagine exchanging dollar for euros while traveling to Europe. You are essentially buying euros with your dollar. In forex trading, you are doing the same thing but electronically and with the aim of making a profit. Market fluctuation. Think of forex trading like a seesaw where one currency rises, the other falls. That's simple as it. Traders aim to predict these fluctuations and profit from them. Okay, so you predict these fluctuations. Okay, you predict that this market will rise, this one will fall, that dollar will rise, British pounds will fall, and the rest. So that your prediction is what makes you money in the forex market. Key concepts: currency pairs. Forex trading involves buying and selling currency pairs such as what? Euro USD, GBP JPY. Okay. Two, exchange rates. Exchange rate that means the value of one currency relative to what another. Leverage. Forex trading often involves using leverage, which can amplify profits but also increases what? Risk. So we are going to be seeing that, and as we continue to learn, you're going to understand this leverage aspect. Okay. Structure of the forex market. Major currency pairs: Euro USD, that's Euro USD, the most liquid and widely traded what pairs. USD JPY, a popular pair due to the economic relationship between the US and the what Japanese. GBP USD, British pound slash USD dollar, a major pair influenced by economic development in the UK and the US. So as a beginner, these are the pairs you should be looking at what trading, because they have some strong fundamentals. Market participants. These are people who participate in the market. One is the banks. Major banks participate in the forex market, providing liquidity and facilitating transactions. Two, brokers. Forex brokers act as intermediaries between traders and the market, offering trading platform and services. Okay, so as this class continues, you also get to see the apps you are going to be downloading for to start up your forex trading, and the broker recommended. Okay, with that broker, that's where you fund your little share of the currency you want, the little share of the amount you want to use to start up your forex trading. Okay, so a broker serves as a middleman to to the forex market. So there's existing brokers you can use. So as you continue this class, we'll show you a broker you will use, and that's what you're going to be funding with, and you start up your forex trading journey. Three, traders. Individual traders, institutional traders, and HND funds and HT fund participants in the forex market, buying and selling currencies. So we have the individual traders, which is me and you. We have the institutional traders, institutional investors. Okay, these are the major players in the forex market. We have the HD funds participants, those who handle major funds in the forex market, buying and selling of currency. Okay, so these are people, these are traders. Okay, these are three types of traders that participate fully in the forex market. Again, you need to know what is called the trading sessions. The trading sessions. One, we have the Asian session, which starts from 12 a.m. in the midnight to 8 a.m. Okay. We have the European session, which is called the London session, Frankfurt session, or Paris. Okay, you can see the time there. American session, you can also see the time. So we have the American session, which is the New York session. We call it the New York session. We call the other one the Asian session, and the London session. How forex trades are executed. Buying and selling currencies. Buying order. A trader buys a currency pair hoping to sell it at a higher price later. Sell order. A trader sells a currency pair hoping to buy it back at a lower price. Using leverage and merging. One, leverage. Forex trading allows traders to use leverage, which amplify potential gain and losses. Understanding bid and ask price. Bid price, the price at which a trader can sell a currency pair. Ask price, the price at which a trader can buy a currency pair. Spread, the difference between the bid and the ask price, which represent the broker's commission. So I know this here sounds a bit technical, okay? But when we proceed into the trading, you into the class, you will get to understand what this side means, okay? What it means by this bid, ask, and what spread, okay? Example: a trader wants to buy one lot of Euro USD at 1.1000, okay? Ask price, that means $1, sorry, that's one lot size, okay? Wants to buy as one lot size, which is the standard lot size, okay? Key key terms in forex trading: pips. So these are the major key terms you need to know in the forex trading, in the forex market, okay? You just need to know these key terms. These are there are many of them here, but you need to know them, okay? Which is the pips, the lot size, okay? These two helps you to actually manage both your risk and manage your account, so that you won't lose your account and you know what you are risking to the market and the profit you are going to make at the end of the day, okay? So one is what? Pips. A pips is the smallest unit of a price movement in the forex market, equivalent to 0.001 or 1 slash, okay, of a percent. Example: if the Euro USD price moves from 1.1000 to 1.1010, it moves what? 10 what? Pips, okay? So if you go to if you progress in the class, I will show you something at the end of the class, okay? Probably I will show you what this thing means there, okay? When you go to trade this Euro USD, you will see their number 1 point, you will see the number 1.17 something something. Do you get it? That means if that price of this token, if the current price of euro at that period is 1.1000, okay, and when you enter the market at this 1.1000 and it moved to 1.1010, that means it has already moved what? 10 pips away. But if it moves 1.009, it means you have moved what? 9 pips away. If it moves 1.005, it has moved what? 5 points away. If it has moved 1.130, it has moved what we call a pip, 30 pips what? Away. Okay, hope you understand it. Significances: pips are used to measure the profit or loss of what? A trade. Do you get it? I said initially that it helps you to manage your account very well and it helps you to maintain profit and losses, okay? So it says significances: pips are used to what? To measure the profit or losses of what? A trade. Key terms in the forex trading: there's two, which is the lot size. I talked about it. The lot. A lot is a standard unit of a measurement for the amount of currency traded in the forex, okay? So the amount you are trading in the forex is what is called lot size. Now we have the standard lot size, which is 100,000 units of a based currency. Minimum lot size, which is 10,000 units of a base lot size. We have micro lot size, which is 1,000 units of a base currency, okay? We have the nano lot, which is 100 units of a base currency. Significances: lot size determines the size of a trade and the potential profit or what loss. Do you get it? So this determines your profit. Okay, pips plays a huge role, but this lot size is what plays the major gain in the market. Okay, and we have different lot sizes like 0.01 is called 10 cents, 0.02 2 cents, 0.033 cents, 0.044 cents, 0.055 cents, 0.06 6 cents, 0.07 to 9 cents. Then you have to 0.1 is called $1. Okay, like that you get to 1.0, which is $10. 2.0, okay, continuously. Okay, so that's it. Key terms in forex trading: one is leverage. So we made that leverage the first time, okay, about 4 slides away. So here is like a bit you know, let's say explanation about it. Okay, the ability to control a large position with a relative small amount of what capital. Example: with 100.1 leverage, a trader can control a 100,000 watts dollars position with $1,000, which means if you have a $1,000 in the market, let me say you funded a $1,000 in your account, okay, you are going to use one standard lot size, okay, targeting 100 pips, okay. That means your leverage is giving you 100,000 position, okay, which means once you hit this 100,000 times it by 10 gives you 10,000, gives you 1,000%. Significances: leverage can amplify potential profit but also increases the risk of what? Significant losses. So the less you leverage in the market, the less losses you are going to what? Incur. The higher you leverage in the market, the higher the losses. Okay, the same thing, the lower the leverage, the lower the potential profit. The higher the leverage, the higher the potential profit. So key terms in forex trading: four, which is merging. Merging: the amount of money required to open a and maintain a position in forex trade. Example: if a broker requires a 2% margin, a trader needs $2,000 to control a $100,000 position. Significance is: merging is used to cover potential losses and is an essential aspect of risk management in forex trading. So you must know how to risk your account. Okay, if it requires 2% margin, okay, so you need to be able to break it down whereby you don't lose much, okay, and you don't risk higher. Importance of understanding forex terms: understanding pips, lot, leverage and margin is crucial for what? Forex traders, as they directly impact trading decision and risk management. One, measures profit and loss. Pips helps traders calculate the profit or loss of a trade. Determines trade size. Lot determines the size of a trade and the potential profit or loss. Manage risk, leverage and margin. Okay, so